Good afternoon. Welcome to the Hartman Fireside Chat. My name is Keith Roddy, President of the Capital Markets. I'm joined by Dave Wheeler, our Chief Investment Officer. Today, we're going to give you an in-depth look at those factors that have impacted inflation and how commercial real estate may be an advantage in diversifying your clients' portfolios. Before I introduce Dave, I'm just going to give you a quick overview of the organization. Hartman's been in business for 39 years with over 8 million square feet of commercial real estate in the state of Texas, valued at over $800 million. We have about a little over 5 million square feet of office space, over 1 million square feet of industrial, and 1.7 million square feet of suburban retail pads, over 60 properties. Another question that we get frequently is, why Texas? Is Texas just, is it diversified enough? As you'll see on this chart, if Texas were a country, it'd be the 9th largest country on the planet. We also experienced tremendous growth over the last several years, including 2020 and 2021, where both Houston and the Dallas-Fort Worth Metroplex had over 100,000 net new people move into the areas in each of those years. So these factors have propelled the success of the company. In fact, in 2021, we had a record-setting occupancy year at 83.6%, adding 600 leases during 2021, making up for lost ground during 2020. So as mentioned, Dave Wheeler is our Chief Investment Officer, the primary architect for the acquisition of our portfolio of over $800 million. And Dave's well suited for that role that he's held the last 19 years. He holds a civil engineering degree from Texas A&M and an MBA from SMU. And prior to joining Hartman, he was a commercial real estate broker with CBRE. So Dave, I'm gonna get right into it here. Can you give us some insights on what's really contributing to this higher inflationary market that we're experiencing?
I will, and I can. Thank you, Keith, for that introduction. It's always a real joy for me to spend some time visiting with you about the economy, the great state of Texas, and how tremendous the growth is here right now, our operational capabilities and our strategy moving forward. But thank you for the question. And let me talk a little bit about inflation. I think everybody knows there's been some prints here recently in recent months, well into the high single digits on inflation. A lot of concern that the Fed is behind the curve, that inflation and inflation expectations are a little bit ahead of where we want them to be, maybe a lot ahead of where we want them to be. This particular chart here shows the 10-year breakdown inflation rate. And what they're really doing, this is a Fed chart, what they're really doing is taking 10-year treasuries, the rate on 10-year treasuries, subtracting the rate on 10-year treasury inflation protected securities. And they're showing you what inflation expectations are over the next 10 years. As you can see, that expectation has risen dramatically over the last couple of years. We're now pushing 3% as an inflation expectation over the next 10 years. Likely that's front loaded. In other words, if we're experiencing high digits right now, hopefully it's a little lower than 3% in the the later half of those 10 years. But certainly right now, inflation's kind of the cat out of the bag. The Fed's chasing it. We got our first rate increase last week. They finished the taper here just probably a month ago or so. And there's this expectation there's going to be numerous more Fed funds rate increases moving forward over this course this year, possibly even some 50 basis point increases. So how did we get to this situation where inflation is the highest it's been in 40 years? There's some concern that the Fed's going to struggle to engineer a soft landing, and that it may be above pre-pandemic trend as well as Fed target of 2% for quite some time moving forward. Well, we got here primarily, everybody knows about the supply chain issues, so I won't dwell on that too much, but we got here primarily because of stimulus. A lot of it has to do with kind of two levels or two forms of stimulus. First of all, fiscal stimulus. This is a summary of all the Fed programs that were passed during the pandemic, and they total up to $5.3 trillion in funding that the Fed put out there into the marketplace to help consumers, to help folks out of jobs, to help folks with jobs, and they really overdid it. I think, anecdotally, we probably all know folks who got a stimulus check who were gainfully employed, didn't need the money, it just went straight into the bank. It didn't really help anything at the time other than to add to their cash cushion. Maybe they spent it on something, but for the most part, it didn't stimulate it. A lot of it didn't stimulate anything. I would tell you, I was reading some press earlier today, and just coincidentally, the AP has a headline out that's only about 2 or 3 hours old. Pandemic relief money spent on hotel, ballpark, and ski slopes. So it's out there, and it was too much, and in many ways it was wasteful. So the other part of stimulus that's relevant and we're talking about is what the Fed did, not just the federal government. All those prior fiscal programs put a lot of money in a lot of people's hands, but the Fed really created a ton of liquidity, drove down long-term interest rates through buying securities out in the open market. This is primarily long-dated Treasury securities in the form of quantitative easing. As you can see on the left-hand side of the chart, there was a significant bump up during the great financial crisis, what we thought was significant, when the Fed increased its balance sheet from $1 trillion to $2 trillion. And then over time, through additional quantitative easing, went all the way up over $4 trillion. But that was nothing compared to what happened in the pandemic. In the pandemic, the Fed had really, in a relatively short time frame, roughly a year or so, doubled their balance sheet from $4 trillion in securities to over $8 trillion. So it's those two things combined are a large reason why the inflation cat's out of the bag. The Fed has let things run too hot, and now folks are concerned about whether they can engineer the soft landing or not. So that's kind of where we are from an inflation standpoint in a nutshell, and how we got here.
Thank you, Dave. Thank you. So part of that process during the pandemic, as we saw, quits rise, as the term has been phrased now, and there's definitely a labor shortage affecting the marketplace. How do you see that impacting commercial real estate in the state of Texas? And I guess as a follow-up to that, with so much migration here, do you see that our state and commercial real estate for us may actually have some sort of advantage in the recruitment of human capital because of those changes?
Yeah, so we've got a slide in here that shows you about the quits rate. And what I can tell you is job openings are up. It's one of the reasons quits are up, because people can leave their job with confidence knowing that they can catch another job. The quits rate is really an indicator of where the balance is in the job market. The Fed said they were going to let inflation run a little hot. They wanted to take care of the unemployment rate. They've kind of overdone it. We're essentially at full employment already. The job openings far exceed the labor pool that's looking for jobs right now. And that quits rate is a strong indicator that that's happening. Within Texas, the quits rate is even a little bit higher, as you'll see on the next slide, than the national rate. And the reason it's higher is because we have even more tremendous job growth here in Texas than we do nationally. We've got employers expanding. We've got workforce in migration. All of that translates into additional housing needs and additional space needs by companies based here or coming to Texas.
Thank you, Dave. Thank you. Well, that's good insight. During this period, we've also seen a dramatic shift in the disruption of the supply chain with a pent-up demand. What impacts does that have on commercial real estate in the state of Texas? And I believe here we have your slide on the Texas quits.
Yeah, thank you, Keith. This one does a great job of illustrating how the quits rate has consistently been above the national average, which just shows the level of job demand here in Texas and shows why there's so much inbound workforce migration. But back to your question about the supply chain, the logistics of the supply chain, the bottlenecks, et cetera, and how that's impacted us here. Well, as you know, the major metros in Texas, many of them, DFW, Houston, are really transportation hubs. The supply chain disruption means that in the industrial space, a lot of those companies trying to get product through the supply chain, whether they be manufacturers, retailers, warehouses, whoever, have moved away from just in time, which requires real efficiency in the supply chain, to just in case. And what does that transition really mean? Well, just in time means you're real lean on your inventories. You're moving product quickly from where it's being produced to where the customer needs it. And when you have just in case, those supply chain disruptions and bottlenecks mean that the suppliers are trying to warehouse things along the way. They're increasing their warehouse space needs to accommodate this just in case, so that when the disruptions happen, they can still deliver product. So you got two key drivers in industrial. One is e-commerce elevating the demand for industrial space. The other is just in case storage happening within the warehouse space. All those things mean industrial demand really accelerated dramatically right into the pandemic. Coming into the pandemic, it was strong. It became exceptionally robust just within a few months in the pandemic. I think everybody knows about the work from home phenomenon and how that's played out in the office market. Retail service businesses have recovered sharply. That's where the largest scale of unemployment growth, a return back to work has happened over the last few months. But now we see companies coming back into the office, and that's a key driver in our portfolio.
Absolutely, absolutely. How do these dynamics, Dave, in terms of supply chain disruption, higher inflation, how do they impact rents and then investment strategies on different types of real estate, specifically commercial real estate here in Texas?
Yeah, so the key thing is there's supply is challenged on the real estate side because construction costs are going up. The rents necessary to justify new construction are going up. So that means that demand right now is playing out in additional construction in industrial space. On the office side, we're not at a vacancy level yet where demand is going to be high enough to create construction. But moving forward, as construction costs rise, if the rents necessary to justify the new construction are up here, it means that the rising tide is going to lift all the boats. If we're in the value space, our B value space that we our proposition to our customers is going to be even more alluring and more attractive as these companies look at how expensive the flight to quality in the A space is. So that's a key driver for us. The other thing I can tell you, Keith, about inflation is we work diligently to make sure our customers pay their expenses separately. So our rent is a direct base rent. They reimburse us for expenses. So to the extent those expenses, and we work diligently to control those expenses on their behalf so their customers are taken care of, but know that we are able to pass on those increased costs directly to them in the form of expense reimbursements from the tenants.
Thank you. Thank you. So beyond that, of course, it's no secret that we've seen this year and recently dramatic increases in the price of crude and natural gas. How does that impact real estate here in our state and in our home city of Houston?
That's a great question. Nationally, I think it functions more like a tax on consumers with the increase in gasoline prices. So it's sort of a headwind for the economy everywhere. It will probably add 1% to the inflation rate that we're currently experiencing. But here in Texas, regionally, that means additional growth opportunity. As you know, we were already seeing significant demand from the small to mid-sized companies that we work with, whether that's Houston, DFW, or San Antonio. But here within Texas, the oil and gas business is still a significant component of the economy, even though we're well diversified. Specifically within Houston, we're seeing tremendous user activity right now and have for the last year in that small to mid-sized space. That's accelerating. And we're beginning to see the impact of the energy companies, small, medium, and large, looking for additional space, adding personnel. Capital investment was limited in this space for quite a while because of the downturn in 2014, because of ESG, and because folks are just really concerned about the space. That lid is being lifted as we speak. Employment's accelerating here in Houston, and that's a great driver for the properties that we own. So thank you for the question, Keith.
Yeah. Well, you touched on this earlier, Dave, but I think it'd be useful to kind of bring it out a little bit more. As a REIT and as a sponsor, how has Hartman met the challenge in the marketplace, in particular with the national news of major organizations taking a smaller footprint in office space because of the work at home concept?
Yeah. The work from home concept, as well as this discussion about flight to quality in the A space, they have truth and they ring truthfully. But the reality is, in the B space, we're providing a value proposition. Our teams work diligently to provide move-in ready suites. Those small to medium-sized tenants that don't want to work from home are eager to find suites they can move in quickly either immediately or within a month or so. They like the fact that we provide those types of spaces. Our property management and operational teams are providing white glove service that they're looking for, and we can provide space at maybe a third of what it costs corporations to find this high quality A space. So it's really a value proposition, and it's the key reason why we're so successful leasing up our buildings.
Good to know. Good stuff. So we hear a lot about multifamily and single housing really booming, in particular in all of our major markets here in Texas. How do you see that crossover, or what effect does this type of growth have in the commercial space as well, Dave?
Yeah, it's a great question. Multifamily has definitely been booming. Single family is still playing catch up. We're just now starting to reach levels of new home production that we saw before the great financial crisis, although it's been 12 years or so since we've seen those kind of numbers, maybe 13 or 14. So the single family market's still got a lot of catch up to do. That will take some pressure off multifamily over time. But in our spaces, I think the relevant thing to know is construction costs, replacement costs, and development costs are rising. That just means that rents to justify new construction are going to continue to rise, and for rents on existing product, as we lease up those vacancies, as we increase our occupancies, and as those submarkets continue to recover, we're going to be able to not only increase NOI by driving occupancy, we're going to be able to increase net operating income by driving rate.
That sort of leads into, how have we as an organization managed the acquisitions that you have led for over 19 years? And will any of that be different in the landscape that we see going forward with construction costs going up and higher inflationary periods?
Yeah, I don't know that it will materially change the way we look at assets. It may change some of the pricing in the marketplace, but I think, as you know, Keith, we work diligently to cover the market comprehensively. We look at 600 to 1,000 investment opportunities per year, quickly screen that down to 75 to 100 that look like they might make sense. And then within that space, work diligently to find the best bargains and allocate the capital to a price point that really gives our customers the kind of rents and the kind of value proposition they're looking for, and at the same time provides attractive yield for our investors.
So to that point, Dave, traditionally, we've had a hard stop on 39 cents on the dollar for replacement cost. As you know, we buy B properties, put CapEx in them, lease them up to in the 80s. Do you see that purchase price or methodology changing any at all with these?
Not really. What I do see changing is the replacement cost rises, so that percentage of replacement cost that we're paying won't rise. The prices that we pay may move a little bit, but I expect that we'll be able to still buy at a significant replacement cost moving forward, based upon the number of opportunities we're looking at, based upon where we invest, how we invest, and how we ascertain the motivations of the sellers that we work with. So I think we're going to have a steady supply moving forward of investment opportunities for quite a few years that really make sense for our platform, that keep us competitive and give our investors real growth opportunities.
Terrific, terrific. Thank you. All right, we have left time for questions for those of you that will send it in through the chat room. So one of the first questions here that we have is, will Hartman provide a replay of this? And the answer is yes, as I understand it. I don't know exactly how long it'll take for that to be uploaded on the website, but we will have a replay. The next question is, how does Hartman mitigate interest rate risk during this period of time?
It's a great question. It's a great question. So thank you for that question. While we often acquire with bank debt that has a floating rate, we will seek to quickly, within a matter of years, put on permanent debt that has a long-term fixed rate. In fact, right now we're working through some major refinance opportunities for the firm to lock in long-term rates and keep interest rate risk managed. So that's the key, is when those properties are available to be locked in at leverage levels that make sense for us and the pricing that makes sense for us, we're going to do it.
Thank you, Dave. Another question that comes in is, what are cap rate expectations over the next few years as we expect to see more rate hikes?
Yeah, so two components of the cap rate, partly driven by the cost of equity, partly driven by the cost of debt. Equity pricing seems to be relatively constant. Today's market, yesterday's market, and moving forward. So I don't expect that component of the cap rate to move any. The debt component might wiggle some. You know, if interest rates continue to rise, we may see some either leveling off of cap rates, no more compression, or some slight expansion. But the reality is, I think a year or two from now, when interest rates have normalized, when inflation hopefully has normalized, and hopefully the Fed can engineer a soft landing, we won't see cap rates that are much different from now, possible slight expansion.
Thank you. We have a good question here. I think I'll put a little more context to it before I pose the question to you, Dave, because we gave a very brief overview, just sort of a thumbnail sketch of the organization. But Hartman as a company is an operating real estate firm, completely vertically integrated with 185 employees. We have 30 members of our own leasing team, our own property management, engineering, construction, et cetera. So we don't contract out property management, leasing, et cetera, as some other companies do. So that's sort of the construct of the question I'm going to ask Dave. It's a good one here. Who are your major competitors in our primary geographic areas?
Yeah, it is a good question. Our primary competitors are fragmented, especially in the office space side. And here's what I would tell you. They're mostly local and regional operators that have to source both debt and equity separately, which gives a big advantage, you know, the way we raise and place capital. So I won't mention any names because there are just a tremendous number of them in a market that's as fragmented as ours is in the office space. The shopping center space and the industrial spaces are somewhat consolidated, even in the B space, but not in the office space. You see a relatively high level of fragmentation. They're almost all private companies. In the office space, they really are our direct competitors. So, you know, our assets are often in the kind of the $10 to $50 million valuation bucket, which is where we can kind of get in under the radar of most of the guerrilla institutions and really find those bargains. So again, it's mostly just local and regional operators who source capital separately.
Thank you, Dave. Thank you. So here's sort of a combo question that I think is a good one. It asks about 1031s and an industrial property. So I know we're developing an industrial property now. Could you give us a little more insight on our industrial property footprint, Dave, and what our philosophy is?
Yeah, so we like all three of the major commercial property types a lot. Industrial, shopping centers, office. Which you can see is that over time, some of the best bargains have been in the office and shopping center spaces. Our industrial property portfolio is, I think it's 5 assets in Houston, DFW, and San Antonio. We also have some land for development here in the DFW area, in particular Northwest Fort Worth, where we have a two building project planned, about 120,000 square feet, catering to small industrial users. So it's possible that could be a 1031 opportunity for somebody downstream, but it will be a while before that product is ready for that type of investment.
Right. So we have a 1031 in queue for the middle of the year. That's a retail pad, and certainly as we continue in our evaluation and acquisition of properties, industrial properties are part of the mix for 1031s, but nothing primarily in queue at this point. So again, how much of an advantage does Hartman have as a vertically integrated company as opposed to those organizations that outsource leasing, property management, et cetera? Does that give us any pricing flexibility or just any general competitive advantage, Dave?
It really helps a lot. I've already talked about some of our other competitive advantages, but really none more outshines any other than this one. This one is really key to our operational strategy, and it's why we can buy challenging assets in the B space, because we are vertically integrated. Our property managers are solely focused on our properties. We're not competing with other landlords. Our leasing agents are solely focused on our properties, and our construction teams work diligently to make sure that we have a broad array of move-in ready suites ready to go. So those internal operational capabilities are essential to competing in the B space. They may not be as important in the A space, but they're definitely essential in the B space, and they're a key reason why we're so successful as an operating company.
Thank you. So last question here. Do you believe supply chain disruption may have a positive impact for the Made in America story?
Yeah, I do. I think pivoting the supply chain is more cumbersome and slower than a lot of people think it might be. I think there's still a tremendous amount of production going on in China, but the concept of onshoring and nearshoring, both producing more goods here in the United States as well as, let's say, in North America, or even in this hemisphere in South America and Central America, are key ones. I do know that a lot of folks that need product, need consumers that need things, industries that need things, are definitely trying to figure out ways to reduce our dependency on China and or Southeast Asia. And I think moving forward, that's going to be a significant factor. The pivot just doesn't happen real quickly.
Thank you, Dave. Thank you. I believe that brings us up to the close. I'm just going to show some of the tools available for the advisors. These are all client approved, a white paper on inflationary economy, why move to Texas, the corporate relocations, and a guide on alternative investments. And you can find us online in all these various locations. And finally, a snapshot of the footprint of the organization so that you know how to find us. If you have any questions, Hartman has a wide range of investment opportunities, a perpetual operating NAV REIT available for advisors with an iShare, opportunistic zone offerings, as well as an upcoming credit facility for the purchase of 1031s, joint venture opportunities, and institutional offerings. So thank you for your time today. We look forward to getting to know more of you better and earning your business. Have a good day. Thank you.
Thank you.